All right, great. Well, I guess I'll begin right now. I can see we've got a bunch of attendees on. We've got some more who have just texted me saying that they're going to be on the way shortly. So I figured we would kick this off. I first of all want to thank everyone who was able to attend today. Hopefully you can hear me clearly. The intent today is our first typically we do seminars. Under the new circumstances, we're going to be doing webinars going forward until we can all get back together again. The intent of today's webinar, originally when we hold seminars for clients, we're talking about first quarter and second quarter outlooks, what we expect for the rest of the year. Obviously, the first quarter this year was not like nothing, no one has seen on this. And looking forward, we're not quite sure what to think of what's going on. An important part, being people's advisor, working in this industry, is leaning on the right sources of information to understand clearly what we're up against, what it looks like going forward. Obviously, there's no guarantees in the future, but the best decisions are usually made with the most accurate information. Hence why our firm has partnered up with BlackRock. My previous career at Ameriprise, we always worked with BlackRock quite a bit. Coming over to LPL, I was very fortunate that we could even expand that relationship, really get to work with some of the analytics that they have. And in addition to that, get to what I call their brain trust. Today, we're going to be having a presentation done by Connor and Katie Smith, Connor McRoy and Katie Smith. They both are at BlackRock. We're going to be starting off with Connor, talking about where we came from, where we are, and what we expect going forward in the economy. We're then going to transition over to Katie, talking about the importance of ESG factoring into portfolios. For people on this call not familiar with ESG, that's environmental, social, and governance. What is it specifically that companies are doing to be better citizens that in turn reward shareholders for working with those companies? There's been a lot of myths around it, a lot of things said about it, but ultimately as we progress, we're finding out those components are becoming critical in selecting the right portfolios for clients. So without further ado, I'm going to turn this over to Connor and Katie. I'd like you to know that after this, we're going to be opening up the line. So right now, everyone should be muted so we can go through the presentation. At the end of the presentation, we'll be unmuting the lines. Feel free to ask questions. Or if you have a question and you don't want to forget it during the presentation, you can always look to the bottom right and type it into the chat, and we'll make sure we address it at the end. So without further ado, I'd like to introduce Connor and Katie. Connor, the stage is yours.
Awesome. Thanks, Chris. Hope you can hear me all right. And thanks for everyone else for joining us today. I tried to share my screen just to check the technology. And if it's not working or you can't see anything, Chris, just feel free to stop me as we go. I hope everyone's staying safe and healthy, and importantly, making the best and finding some silver linings in the current situation. I know me and my family are. Again, my name is Connor McRoy. I'm really glad to be with you, and I'm glad to work for the investment firm BlackRock and represent BlackRock as a firm in Greater Los Angeles. I spend most of my time, probably all of my time, partnering with financial advisors in California, and we assist on a number of different things, including investment portfolio building, risk management, and also financial technology that Chris alluded to, and we partnered really closely with Signet Wealth Management already this year. Today, I think we have some really unique insights to share with you, and just to lay out a brief agenda, there's really three things that Katie and myself look forward to delivering to you in hopefully a really time-efficient manner. First, I'll spend just a quick minute on the screen here talking about really who you're talking to, which is BlackRock as a firm, and just give you a bit of a more formal introduction into our firm, but also our position within financial services today. Secondly, there's no shortage of unanswered questions that we're all living through relating to financial markets and outlook in relation to the COVID-19 crisis. We would like to share some of BlackRock's view, but also talk about what we believe is the path forward and help provide some, in my opinion, much needed clarity around a situation that's been dominated by a bunch of headline noise. And then lastly, I'll turn it over to my better half and partner, investment specialist Katie Smith, to share what we call an investment megatrend that has been really amplified and shown its worth already in 2020. And we believe very strongly, and I know Chris shares this same view, that sustainability and ESG is a mega trend that's going to continue to be rewarded from an investment standpoint going forward. So just get up and running here. a quick minute on who we are and really what BlackRock stands for. Our firm is very unique. Most audiences that once upon a time I spoke in front of and now we do virtually have some familiarity with BlackRock as a firm. At this point in time, you can see on the screen here, BlackRock is the largest manager of client assets in the world. At the start of 2020, and this number's come down a little bit with market movements, but BlackRock and iShares, which is a franchise that we own, global clients have entrusted our firm with just right around $7.5 trillion of client assets. An important thing that just to note, as you can see in the bottom left there, none of this and $0 from our firm is done from proprietary trading on our own balance sheet. We are not a financial advice firm or an investment bank, but rather we partner exclusively with financial advisors to deliver solutions to their practice and to ultimately into your portfolios. And we offer a variety of different investment solutions, from mutual funds to exchange traded funds, sustainability focused strategies, and a lot of those have probably made their way into your portfolios at some level. But if you Google our firm or you Google BlackRock, what you'll hear about time and time again is a system called Aladdin, or risk management technologies. And Aladdin is a financial technology that we partner really closely with Chris and his firm to help better understand portfolios. And a lot of this technology hasn't been embraced by Signet Wealth to help better understand the risk management in your portfolios and your end accounts today. And that's really what BlackRock as a firm has really earned our brand on, is really just understanding risk and being a really unbiased and diversified asset manager or money manager. So now, just as we've gotten you a little bit more familiar with our firm, to move into the meat and potatoes of the presentation today, in an effort to provide some form of clarity around markets today, the second part of our agenda will be all focused around our very recently updated market outlook from BlackRock as a firm. And again, we now know that these are really challenging times. And above all else, I hope everyone finds us today safe and healthy and finding some extra time with families. But for markets, however, these have been some of the most volatile times in history, no matter how far back you look. We will do some sense in the next couple of minutes here to make some sense of what's happening, and ultimately what to focus on in the future as well too. And ultimately, as challenging as it may be, we hope the message here will help you think a little bit more long-term. And in times of crisis, this can be more difficult than usual, and no one is immune to fear and uncertainty. But times that are really stressful, it's most critical to think as long-term as possible. And this presentation, to Chris's point earlier, is directly from our quote-unquote brain trust, but it's really a culmination of BlackRock Investment Institute's best thoughts, and gathers insights around all different aspects of our firm to effectively build this view of what does BlackRock think. And maybe just to get started here, we will start with the bottom line, and which is very simply, we view the coronavirus shock that we've all lived through in the last couple of months in terms of more a natural disaster, and a really large-scale natural disaster. Think of a massive hurricane or an earthquake that severely disrupts things over a really short time period, but eventually results in a major economic recovery. And we do believe very strongly that this coronavirus shock is not a financial or economic system letdown, but it's actually one of these unforeseen natural disaster type events, which we will get out of at some point, hopefully in the near future, but we can also learn from extensively through this process. And while market movements have been really reminiscent of the financial crisis in 2008, again, we do not think that this crisis is anywhere close to that in 2008, in large part because the economy and the financial backdrop of the country is much, much stronger than it was the better part of a decade ago. The key difference is the 2008 crisis was stemmed from the economy, financial sector, and the actual banks themselves, which ultimately led to a multi-year period of deleveraging business. And this was done, if you remember, by companies reducing spending in huge areas and in huge degree, and think about areas like research and development, laying off a number of different employees, closing plants, stop spending, et cetera. That's how the financial crisis in 2008 was effectively, we crawled out of that effectively. We do not believe that this situation is similar to that from that standpoint. So while the shock today has felt far more severe and acute, in large part because it happened so quickly, we believe very strongly that we're on much stronger footing and are poised for a major, major recovery. Perhaps not fully by the end of the year if we're being realistic, but certainly quicker than the 2 to 3 year period that the financial crisis took. And the last part to make, which is meaningfully different, is the policy response that's already been made this year so far. The culminative impact of the crisis over time may only be a fraction of the global financial crisis, in large part, and we'll talk a little bit more about this later, in large part to the amount of stimulus that has already been in effect. And if policymakers continue to be successful in preventing the shock to take a larger effect on the broader economy, but a more prolonged shutdown, the greater the likelihood that cracks will appear, exposing some potential vulnerabilities that could lead to more permanent damage in some areas of the economy. But as of now, we believe that the bold and very broad policy responses that have already been made so far in the last couple of months have done a successful job in limiting risks so far, but also reducing the amount of time that will be in a full-on recession, which is a really unique point that's very different than the 2008 crisis as well. So moving on a little bit further here, what does the path to recovery look like? We are looking for signposts as a firm in 3 really key areas. The first is, and we'll talk about this here in a moment, the path of the virus itself, gaining some greater clarity of the true scale of this virus, and also finding evidence that the infection rate has peaked over longer periods of time. Secondly, policy responses, as we've already mentioned before, but the ongoing deployment of credible and coordinated policy packages. You've already started to see a bunch of that, and there's probably a lot more of that to come, and we'll talk about that here in a moment. And the third is the economic data and confidence that financial markets are in fact functioning properly. So first, the path of the virus, if we're on this slide here, is both the most uncertain, but also the most impactful factor to a market recovery at this stage in the game. When our money managers at BlackRock and iShares are polled and surveyed around which factor is most important, and when they're considering and taking on more risk in financial markets at this point in time, the majority in this poll answered the dynamics around the virus itself. And that was chosen over other selection options like growth data, policy, valuations, economic data, all those type of things that we traditionally look at, all those type of metrics that are traditionally looked at by portfolio managers, has been trumped by the virus itself. The challenge has since become that the near-term outlook of markets is as uncertain as the near-term outlook of the health crisis. And those two topics have become almost synonymous at this point in time. And market movements are so closely tied to health crisis data that it's almost impossible at this point for us to separate the two items. But as it appears, while the death toll has been devastating, stringent shutdown measures, as you can see on the left-hand side of the page as to how quickly these crept up, have helped stem the spread of the virus and the disease. And we are nearing or past the peak in the US, and especially in certain areas, we think we're already moving beyond that. So there are some true glimmers of hope in the near term. Our belief is that as we move through the end of this month and through June, we'll see a continued staged reopening of a number of economies globally, specifically in Europe, and of course the United States to follow as well. And we're already starting to see those take place across the country today. And those are really, really encouraging signs. And it's why you're seeing economic and markets today do so positive, is because as there is more confidence in the reopening of the economy and a move back to normal life, markets will continue to rally and do quite well. And what these charts on the screen are sharing with you is on the left-hand side of the page, how quickly the shutdown measures happened. And you can see the US in yellow there. But also on the right-hand side of the page, you can see across all of these major markets, whether it's Italy, France, Germany, the United States in yellow, how we are already starting to flatten the curve of active cases and theoretically the spread of the virus. So secondly here, as the policy responses, in our opinion, have been nothing short of remarkable and unlike anything we've seen historically. And we believe that this has actually been underappreciated in markets and amongst consumers at this point in time. In the US, both sides of the aisle may be a little jaded from a political standpoint in the political process, but in the face of the crisis on a bipartisan basis, Congress has really stepped up from an economic relief package standpoint. And this has really been unprecedented in American history in terms of the amount of support for individuals that have been forced out of work, unfortunately, small business relief programs, and also larger businesses that have been especially harmed by this crisis as well. And that's truly a pretty extraordinary thing, and it's a lot of the American spirit coming through. But when we hear the talking heads on the news call COVID-19 the invisible enemy, we believe that these measures that are being taken from a policy standpoint today are much more in the mindset of something that's equivalent to wartime mindset, as opposed to a standard run-of-the-mill recession or even a financial crisis. That degree of whatever it takes type of mindset from policymakers offers a really high degree of hope that we're all going to get through this sooner rather than later and actually come out of it on the other side that with an economy that accelerates, I believe, and our firm believes, faster than some people actually are giving it credit to at this point in time. And this graph here is actually highlighting historically how much economic stimulus has actually been pumped into the economy on an annual basis. And you can actually see what was planned at the start of the year in 2020 and what's actually happened in 2020 with this COVID-19 outbreak. It's a really big discrepancy. And the amount of money that's being pumped into the system to aid those individuals and businesses is nothing short of remarkable. And if you were actually to compare it to the financial crisis in 2008, if you take these 3 years between 2008, 2009, and 2010 and add them all up together globally, you can see that it doesn't even really come close to the amount in terms of how much we've actually pumped into the economy on a global scale. So there's no shortage of appreciation from our firm into the amount of policy responses that have already taken place this year. Another question we get all the time when having these conversations is around the Federal Reserve's balance sheet. And this chart shows what the balance sheet could look like by the end of 2020 on the right-hand side of the page, compared to the start of the year or through March 4th before the major outbreak actually happened. BlackRock's heads call this response as somewhat of a policy revolution, and the graphs here should actually be encouraging as they show the sheer scale and commitment that our policy and administrative forces have to stemming the impact on businesses, individuals, and the broader economy. And with that, we actually are assuming that the Fed may have to increase its planned spending from here for the payroll protection and also expand its support for states and municipalities. And I know Greater Los Angeles and California as a whole, as well as New York, are a couple of the areas within municipalities that are probably going to feel a lot more of that economic stimulus. And we do expect to get a little bit more clear rhetoric and data around specific municipalities and just how much support are going to go into these certain areas of the country that have been affected a little bit further than the broader country in general. And lastly, if we're on this slide as well too, we are really closely monitoring economic data as well at our firm as a really key signpost for the speed and strength of the recovery. These graphs here on the screen show the estimates from top economists, not just our firm, for what they anticipate economic growth will be for the remainder of the year. And you can see In this light gray box here, or this light gray shadow on the left-hand side of the page, there's a really, really big range of estimates around the predictions from a growth standpoint in the country for this quarter, next quarter, as well as the foreseeable quarters after that. And there is no doubt that in the coming months, we will continue to see major negative impact on GDP, unemployment, and earnings. But over the long horizon, several sectors may face higher levels than average from a disruption standpoint. And long-term disruption may be a little bit different depending on what sector you look at, which we can certainly talk about. But you think about those sectors like air travel, fossil fuels, healthcare, retail, government regulations, the feeling of those different sectors is going to be vastly different, whereas a sector like healthcare is probably going to be really heavily supported through this crisis and potentially after it as well too, where other sectors and other industries like air travel and fossil fuels are not going to feel the same level of kindness or stimulus into their specific businesses as well. The pandemic adds fire to things like global trade tensions as companies are really starting to rethink their global footprints. And this combination of not only supply shocks, but they could certainly weigh on growth, increase production costs, and ultimately pressure margins of companies to ultimately drive up inflation over the long term. The historic and still rising employment data, if you want to take a look at another data point that we're closely monitoring, has also put a really big question mark around the amount of consumer spending we'll see going forward in the relatively near future, I should say. And this has probably been the economic data point that's been dominated in headlines as of recently. But unemployment has spiked very quickly. And typically what follows as more people are unemployed and are losing their income streams, consumer loans is the other thing that typically moves in tandem. And the amount of loan delinquency on consumer loans typically starts to move higher as well too. I think the good news of this is that we hope the individual stimulus plans from the US government that a lot of individuals across the country have already started to feel the benefit, paired with the continually reopening of the economy in the coming weeks and months, will help flatten the curve, not only around the unemployment, but also keep that consumer strength chart in yellow there as strong as humanly possible and somewhat intact over the coming months to years. China, if we can point to another place across the globe that can give us a little bit of an idea of what's to come, China can be that glimpse. Supply chains overseas in areas that have already felt and kind of moved through this virus outbreak have held up remarkably. So supply chains have held up reasonably well, but consumer spending is what's started to lag behind, and people do not have the confidence to really spend as much as they did pre-crisis. And we may see that similar effect take hold in the United States over the coming months to a year. Now, we are certainly hopeful for the long term and a better future. The reality is that the near term still remains pretty uncertain, and we're continuing to get more clarity on a daily and hourly basis at our firm. We hope that, and we are likely to remain in periods of uncertainty, unfortunately, but with heightened volatility going forward until the path to ultimately defeat the virus becomes clear. And as mentioned in the beginning, we are continuing to be flooded with information, both positive and negative. So keeping a clear mindset and controlling what we can control in our portfolios is ultimately the best steps to take. So a couple really important reminders before I send it over to Katie to close it out with some ESG information. It's worth recognizing this example on the screen and the idea that, in fact, your diversified portfolios, assuming a lot of folks on the call own some diversification in their portfolios, which I would imagine they do, has actually worked this year. And if you look at this bottom chart here, 2020, if you look at the end of March, the S&P 500 or the US stock market was down somewhere in the neighborhood of 20%. And if you take this hypothetical diversified portfolio in this exact same year, a 60% stock, 40% bond mix was actually only down around 13%. And if you're like me, you don't like to lose in markets in any time period, But when you actually build thoughtful portfolios and are committed to this diversification story, being down less this year is actually winning, and it's winning in a huge way for you. And if you stretch that performance out over multiple market cycles, as we are all long-term investors on this phone call, diversification actually outpaces almost all markets over the long term, and that win more by losing less mindset is the successful investment mantra to have, especially in periods of stress. And these comparisons can be run on an individual basis, but this example on the screen takes you over basically 2.5 full market cycles, from the tech bubble in the top of the screen there, the financial crisis in 2008, and the 2 bull markets in between. What you'll actually see on the bottom here, which is really interesting to us, is that the way the math works out, if you protect more on the downside, you can still lag on the upside, and the total return over full market cycles compared to the S&P 500 is actually you outperform owning less stocks and being more conservative over longer periods of time. So that's a really important lesson to keep in mind. And then the second reminder here is, and one that we've already helped Chris and Signet Wealth with this year, is that simply the effect of rebalancing in periods of stress. When markets get dislocated, your portfolio starts to drift away from your target asset allocation, and rebalancing during a period of market volatility actually serves 2 really key benefits for you over the long term. One is pretty obvious. It gets you back to your target asset allocation in order to meet your long-term goals. So if you thought about a 60-40 portfolio at the start of this year, through the end of February of this year, you started with 60% in stocks and 40% in bonds. That same asset allocation, just based on market movements alone, actually felt more like a 50-50 through the first 2 months of the year. So right there, you basically had a 10% shortage of equities or stocks in your portfolios, which will really throw off your long-term return targets. But also, the second thing that rebalancing does in periods of stress is it allows you to take advantage of price dislocations without you really even knowing it. And when you rebalance up in this example where your bonds have outpaced your stocks this year and you actually rebalance to buy more stocks, you will be buying things at a cheaper price, really the cheapest prices we've seen in the better part of a decade, and actually tapping into value simply by moving your asset allocation back to where you started. And my favorite quote in finance is that investments is the only industry in the world that when the on sale sign goes up outside of the store, people start to leave. It makes 0 sense, but it happens time and time again during periods of stress. And when you rebalance, you start to take advantage of that clearance rack, so to speak, and start to buy things on sale that haven't been on sale for the better part of the decade. The last part of this presentation deck actually transitions perfectly into our last segment. And the most common question that we get asked as a firm, and I'm sure Chris gets asked as well, is what do you like, or what should I buy now? And over the long term, in times of stress, we believe, but especially in periods of market volatility, you should be filling your portfolio with quality companies. Quality to us means good balance sheets, low amounts of debt or leverage for these companies, high and strong levels of cash flow, and ultimately will be able to handle uncertainty or economic downturn, and in this case, an economic shutdown, which is somewhat unprecedented, better than the average. As markets have dipped this year, you're starting to see the benefits of owning higher quality, and the higher quality of the company this year, the stronger their balance sheets, the better their performance has been, and the better they've held up during a period of major market uncertainty. Quality at BlackRock is also synonymous for sustainability. And ESG and sustainability to us is no longer just a political or a social term. It has quickly become the #1 investment focus and mega trend in our industry at this point in time. It's one that BlackRock is really passionate about, and one that Chris and Signet Wealth have embraced in order to provide the best possible investment solutions for all of you. And to round out the call today, I'm going to turn it over and bring up some other information around ESG, but I'll turn it over to my partner, Mrs. Katie Smith, to talk you through sustainability and also the importance of embracing it in portfolios today. So with that, Katie, I will pull up the slide deck around sustainability. We can go from there.
Excellent. Thanks so much, Connor. And thank you to everyone on the call. As Connor mentioned, I'd like to echo, I hope everyone out there is staying safe and healthy and hopefully getting to spend some more time with family. As Connor mentioned, we're going to be focusing on ESG today. So we're going to begin by talking about why sustainable, why does that make sense? We're going to help define ESG. So what does that exactly mean and what does it uncover? And then we're going to discuss how sustainable investing has evolved over the last several decades. So Connor, if you don't mind flipping it to slide 4, why don't we start there? Perfect. So sustainable investing is about investing in progress and recognizing that companies solving the world's biggest challenges may be best positioned for growth. What we've seen during this COVID sell-off is what we're calling it, or the most recent market activity, is this is actually being accelerated as well. So these companies are really pioneering better ways of doing business and creating the momentum to encourage more people to create a sustainable future. Now, in his 2020 annual letter to CEOs, Larry Fink, our CEO at BlackRock, addressed the growing importance of sustainable investing. In particular, he actually emphasized that climate change has become a defining factor in companies' long-term prospects and will lead to fundamental reshaping of finance. I know we can all relate living in the state of California, if you do, with the wildfires we seem to be experiencing on a yearly basis every year. Connor, if you don't mind going to slide 6. So society's changing attitudes towards sustainability represent a structural shift for investing on a medium to long-term horizon. And we believe in the near future, there will be a significant reallocation of capital. And this is going to be driven by 3 key forces. Number 1, climate change. 2, investor preference. And 3rd is the institutional integration we're seeing. Next slide. The mounting enormity of climate change is, sorry, Connor, actually one prior to that. There we go. The mounting enormity of climate change is really fostering sustainable behavior. In fact, over the last 5 years, total cost of billion-dollar wealth and climate disasters in the US exceeded $530 billion. So the rapidly escalating physical impacts of climate change, as well as society's reaction to climate events, including a regulatory push and technological advancements, are leading to growing awareness and interest in sustainable choices. We go to slide 7. Investor demand for sustainable investment solutions is increasing across demographics as well. And in fact, a recent study by Morningstar showed that 72% of the US population expressed at least medium interest in sustainable investing, and 44% expressed a medium to high interest. Sustainable investing allows investors to align their investments with their lifestyle choices and is starting to see broad interest really globally. Next slide. Last but not least, I would say the large institutions like public pensions, insurance firms, central banks, and regulators are increasingly focused on sustainability-related investment risks. These investors recognize that sustainability risks are investment risks and are beginning to integrate environmental and social governance considerations into their investment processes. One study showed, in fact, that 70% of institutional investors have already implemented ESG strategies. And we believe these forces will continue to drive persistent investor flows into sustainable investments. So what does ESG exactly mean and what does it uncover? Connor, if you don't mind flipping to slide 10 here. So environmental social governance, and ESG, a term you may have heard, refers to analysis, and it's an important part of our robust investment process. ESG analysis can help investors uncover opportunities such as effective management of resources like water or energy, or a company's ability to benefit from advancements in clean technology. ESG analysis can also help investors uncover risks such as poor data security practices, vulnerability to extreme weather, or the presence of accounting frauds. Things I'm sure you can all think of events in the past where this has existed. These such ESG issues can have a real financial impact as well. And to pursue competitive risk-adjusted returns, investors really should consider the full set of risk and opportunities facing a company, which we believe also includes considering ESG issues. Next slide. So let's go ahead and break down what ESG analysis into its 3 pillars. So I'm sure, again, you've heard this term, environmental and social governance is what the ES and the G stands for. The environmental pillar can include risks like climate change, pollution control, waste management. It also includes opportunities such as whether a company is poised to take advantage of trends in clean energy. The social pillar here in the middle can include risks related to human capital management, product liability, or data security. It also includes opportunities such as whether a company provides services to underserved consumer segments. The governance pillar can include issues such as corporate governance, ethics, corruption, accounting practices, etc. So considering these issues can really help investors gather more information about a company and enable a more comprehensive evaluation of an investment opportunity. Next slide. ESG investing can really provide an additional lens into a company's potential long-term value by helping identify some of the risks and opportunities that aren't always captured in what we would consider maybe a traditional financial analysis. So for instance, consider two companies that have similar financial profiles but differ on ESG indicators. And I would ask, which one of these would you invest in, company A or company B? Now, let's move into how sustainable investing has evolved. So Connor, if you don't mind flipping to slide 14. Sustainable investing really became established in the 1960s when certain investors and religious organizations focused on avoiding specific industries. Now, what we've seen is since then, sustainable investing has evolved considerably in response to the demand from investors and growing availability of ESG data. Today, the ESG research industry is made up of a growing and vibrant set of companies that collect and analyze data related to a diverse array of ESG issues. Investors today may focus on both the exclusion of certain companies or sectors, as well as inclusion of companies that demonstrate positive ESG characteristics. So why don't we go to slide 16, Connor? So at BlackRock, we actually have a long history of leadership in the sustainable investing space. So starting in the 1970s when we offered screen strategies, from then to now, our approach to sustainable investing has evolved pretty considerably. This year, BlackRock advanced its commitment to sustainable investing by making it our new standard for investing across the board. And sustainable investing is now embedded in the firm across our 4 key pillars. With the investment process, which means all investment teams at BlackRock consider ESG issues in their investment process. Sustainable solutions, BlackRock is committed to providing a broad range of dedicated sustainable solutions to investors. The investment stewardship, BlackRock has the largest team in the world with over 45 investment professionals focused on shareholder engagement on material ESG issues. So this team engages with companies that are held across both our sustainable and traditional investment strategies. And then last but not least, the corporate sustainability. BlackRock has a range of initiatives focused on improving the environmental social governance characteristics of the company. Next slide. So just how BlackRock defines sustainable investing as the combination of traditional investment approaches with environmental social governance insights. BlackRock's created a framework that can help investors like yourselves understand different styles of sustainable investing. So investor motivations often fall into one of 2 categories, which we would see on the left-hand side being avoid and the right-hand side being advance. Avoid is about eliminating exposures to certain sectors or activities, and advance is about aligning capital with certain behaviors or activities or outcomes. So we think about exclusionary screens. These are going to be things that seek to eliminate exposures or companies or sectors that pose certain risks or violate an investor's values. So think of things like screening out companies involved in fossil fuels, firearms, tobacco from a portfolio. The broad ESG are going to evaluate companies based on their overall environmental social governance performance, but keep a broad market exposure while investing in companies that best manage ESG risk and opportunities. Thematic ESG focuses on a particular environmental social governance issue. Think of things in this category like targeting clean energy companies or companies that may promote gender equality. And last but not least, impact. So impact is going to be the category that looks to achieve a measurable sustainable outcome along a financial return. So this would be things like investing in green bonds that finance environmental projects like new solar panels. And we could go to slide 18, Connor. So with iShares Sustainable ETFs, we provide an expanding menu of choices for investors and something that Chris and Signet Wealth use as well, looking to implement sustainable investing strategies. So ETFs really can provide an easy, accessible, affordable way for investors to take a transparent approach into sustainable investing. With the broad ESG ETF, this allows you to access broadly diversified exposures for the core of your portfolios For example, ESG aware ETFs provide investors access to high-rated ESG companies while maintaining similar risk and return profiles similar to traditional market cap weighted indices. With the thematic ESG ETFs, these are going to provide access to specific themes that investors can use to tilt your portfolios towards specific exposures. For example, the iShares Global Clean Energy ETF, ICLN you see here, provides exposure to the top 30 global companies involved in the clean energy sector. Now, impact ETFs allow investors to pursue a measurable sustainable impact on the environmental or society alongside a financial return. For example, just like we discussed on the last slide, the iShares Global Green Bond ETF, BGRN, provides exposure to global investment grade green bond issues to fund environmental projects. So if we can go to slide 20, Connor. So our iShares ESG aware ETFs seek to track indices composed of companies with higher ESG quality scores while pursuing similar risk return characteristics as a traditional broad market indices. And they provide asset allocation building blocks that are used to build core portfolios. And I know we're running up on time here, so we can go ahead and end it with that, and we'll turn it back over to Chris, but we're here to help with any ESG related questions or anything else that we can help you with at BlackRock. So Connor and Chris, I'll turn it back over to you.
Sure. Connor, can you hear me?
I can hear you great, yes.
Great. Yeah. So, I mean, in summarizing this whole thing, it's really understanding two things, right? First of all, this is going to be a fluid situation. What's going on with coronavirus, all the limited information and data we get at it, ultimately becomes anyone's guess until you start really looking at the underlying facts. And to your point, the stimulus that's been put in, I saw today in the news that we're up to 100 possible companies looking into a vaccine at this point in time, and that number is continuing to grow and continuing to grow. I think those provide a lot of long-term opportunity and value. The question is in which way do you seek out that value? And so part of the value proposition is looking into ESG style investments for anyone. For clients on this call today, some of these things they've actually seen in their portfolios. They're seeing these acronyms, but it's really about understanding it. And where my background came in on this was in coming out of 2008, when things really got rough. When we watched a recovery happen, what I started to understand at that time was the recovery was not equal. Certain companies were coming out of it and they were coming out stronger than before. Other companies were just limping out of the recession and never really able to get their footing back. And when I really explored what it was and why it was, there were very clear differences. Companies that were able to come out of the big economic downturn had very transparent boards that were governing their companies. They were promoting all people within, not just a certain person in that. They were respectful of their environment, and they weren't paying attorneys to fight environmental lawsuits, but rather reinvesting that money back into their company. And when you look at the performance of those companies that came out of 2008 and really focused on their ESG metrics, their performance compared to their peers who weren't focused on that were startling to me, the differences. And that's when I realized we can actually be doing a lot better without making this too confusing, hence why we started to focus on ESG at the firm. And throughout the year and going back for a few years now, it's been a much better solution for a lot of clients. So I just kind of wanted to give that background into it. Connor, is there anything you want to add?
I wouldn't. I would just say that if you kind of poll, I think a lot of these investment trends come and go, but I would say ESG and sustainability from an investment thesis is one that our firm has really put a lot of assets and thought leadership behind. It's something that we don't think is going away, and it's something that we're very, very committed to. And as the world's largest asset manager, we think that ESG is going to be the way to invest going forward.
Great. So in saying that, now is the time to get into the weeds. We've got a bunch of participants on here. I know that some people may have some questions or whatnot. So I think we have one question up here that someone sent in anonymously. But if anyone else has any other questions for myself, for Connor, for Katie, now's a great time to either raise your hand, let us know you'd like to ask something, and we'll go through it. If you don't have the time right now and want to privately send me an email or give me a phone call later, that's fine too. So Connor, I'm not sure if you can see that first question we got up there.
I can. So Chris and Signet Wealth build multi-vendor portfolios. So BlackRock and iShares is not going to be the only asset manager in these accounts that you guys have. Within the BlackRock lineup, we represent a bunch of different ESG focused strategies, but within the Signet Wealth models, there's really two strategies that are represented. One is an equity strategy called BlackRock Impact US ESG. Sorry, that's a lot of acronyms, but it's basically just our large cap US stock portfolio, specifically screened for ESG focused stocks. You know, the other side of the fence, this one's a lot easier to say, but within the fixed income or the bond space, we have a strategy called BlackRock Impact Bond that's also represented within Chris and the Signet Wealth portfolios as well too.
And I think it's important to touch on that because, you know, the ESG portfolio we were looking at in the mutual fund for equities, the stock one was pretty easy to understand that, but for some clients, they wanted to know why we had such a big change around the fixed income parts of our models this time around. As you know, most on this call know we had a big rebalance at the beginning of April. And a big part of that was that in borrowing all of this money and in all of this debt being created, it is very important to have the managers look at who is creating the debt and can they actually pay this back. You know, the bond market, it seems pretty simple, it's pretty docile until interest rates start going crazy. And when you're actually looking at companies saying, okay, I've lent you this money, are you able to pay it back? So the inclusion of that fund was extremely timely because going forward, even though you want to stay diversified, you have to be very careful as to what you're diversifying into. Not all things are the same. Not all things are very equal. So although, you know, bonds don't seem to be a very attractive area to talk about, the inclusion of that BlackRock bond fund was a massive win for us in that portfolio. And we're starting to see that now translate into return in the portfolios themselves. So very, very nice to have that included in there. I see another question we got regarding inflation. Connor, can you see that?
I do see it. So Dave, I think the inflation picture is pretty straightforward at this point in time, in our opinion. We think with the amount of individuals that have unfortunately lost their jobs for either a temporary standpoint or for a more prolonged period is going to really put an anchor or kind of weigh on the amount of consumer spending that's done. And historically, consumer spending is the number one indicator of how quickly inflation rises. So we do think that inflation is going to be a lot lower for a lot longer. You know, at this point in time, pre-crisis, we were experiencing somewhere in the neighborhood of a 2% inflation rate, which is pretty right on what I think the Federal Reserve was targeting over the long term. That number has come down pretty drastically, pretty quickly. We think it's going to stay sub probably 1% for the time being, but hopefully it will actually gravitate back toward that 2% target. But that's going to be a little bit of a longer term process, so to speak, as more confidence gets regained in the economy. So short term, to answer your question directly, inflation is going to be lower. And then long term, we do expect it to gravitate back toward that 2% level.
Okay. Connor, I do have another quick question for you.
Sure.
In some of the slides you were showing us in regards to the stimulus that was pumped in by countries, I noticed with China, going back to 2015, they were already flooding their economy, it appears, to be with some form of stimulus. So when you go back to that chart and you look at it, and then you see on the far right, the 2020, where you had mentioned, like, look, you know, this is what we think we're going to do in the US, but here's what we did. When I go back to 2015, I see a lot of that already occurring in China. And so I'm just curious as to what your thought leadership is on this in regards to how China actually comes out of this, because A, they're such a huge trading partner with us. B, we're obviously having issues with them. But looking, you know, back here at this chart and what we all reviewed together, when I go back to 2015, 2016, you know, they're a big, big player in that kind of manufactured stimulus for their economy. And so what do you guys, you know, since they had already started this back in 2015, it appears, do you think that China is going to start really feeling the effects of this coming out? Do they look like they're going to be much stronger, or is this something where China is still on the ropes and this trade war really starts kind of messing with their prospects on the way out?
I think a lot of countries have started to lose a little bit of confidence in dealing with China through this crisis due to the fact that historically a lot of their data is somewhat manipulated. And through this, we do believe at some point, and again, political views aside, there has been a little bit of kind of a gray area in terms of what they've actually reported and what the actual reality is. So I think there's a couple of parts to this question. The first part I would say is these countries go through different business cycles at different times. So during our expansion in 2015, China as a more emerging market country is still probably feeling the effects of having to somewhat recover from a previous downturn in their economy, or just the fact that as an emerging market country, typically a lot of those countries pump a lot more stimulus. And as you can see, the pink portion of this chart is oftentimes the largest of all these different on an annual basis. So China has been a place where there's a lot of economic stimulus constantly being pumped into the system in order to spur economic growth. And that's just the nature of them as a more manufacturing-based economy historically, and the fact that they're still less developed theoretically than the United States. So I think out of this recession, what our firm would tell you is that China's in kind of a tough situation where a lot of these countries, whether it's the US or the European Union or some of the Asian countries that have relied heavily on China, are starting to look at other places where they can either outsource some of their, whether that be manufacturing, or find other trade partners to work with that are theoretically a little bit more reliable. So China's in a little bit of a difficult situation, probably a pretty big difficult situation going forward. And that's one of the reasons that they've focused on historically pumping a lot of stimulus into their economy over the long term in order to spur a lot more growth than what was natural in their economy, if that makes sense.
Oh, it does. Thank you. Okay. I see Cheryl has a question. I see her hand raised. So I didn't know if she was going to type that out, or maybe if we could unmute her. Cheryl, if you want to ask it.
I believe I just unmuted Cheryl.
Okay. Cheryl, I don't know if you can hear us or not.
Here we go. Okay. Hi, everybody. I was just wondering, speaking of China, is there any thoughts about what China is intending to do with Hong Kong and how it's going to affect the world economy? Or will it?
In regards to what, when it comes to Hong Kong, just maybe a little bit more information on your question would be helpful.
Well, I just know that there's a lot of talk in the news about Hong Kong changing its policies China changing its policies towards Hong Kong and pretty much bringing it into the fold of China rather than allowing Hong Kong to continue to run it somewhat independently. Does that have any impact on the international market?
I think it certainly would. Why don't I do this? I'll try to get some more clarity around that situation and maybe get it over to Chris, and I'll let Chris communicate that to you once we get some better answers for you.
All right, thank you.
Great, I got it down, Matt. Thank you. Cheryl, what I do know about the situation so far from what we've actually seen happening is, the big question is, with the way things have been, it's really, two systems, one country, right? China's
Right.
always looked at it as we're all united and you're going to have your own way to run and we're going to have our own way to run. But what we are seeing is through legislation in China and whatnot is they're really trying to circumvent that and have it be one system, one party. So to your point, Hong Kong does play a vital role in the global financial picture. But what that is actually going to mean or do, first of all, I think anything that occurs is probably still a ways away from actually feeling it. Additionally, and this is just my guess, is that with what is going on in the global stage with China right now, picking an additional fight with Hong Kong while you're still working over trade disparities with the United States, and now coming to light all of these new Chinese publicly traded companies that aren't really being accurate in their accounting. I don't know if this comes to a head this year. I don't know if the Hong Kong question actually gets punted or not. I know Connor will look into it. I'll look into it. We'll make sure to get back to you. But I do believe that this is the Hong Kong story, I don't think is going to end abruptly with a resolve. Rather, I think this is going to be one of those things that keeps going and keeps going and keeps going until some other issues are absolutely resolved first, i.e. is the virus contained? What does trade look like with their major trading partners? And how much trade will be affected should they choose to pursue an aggressive strategy with Hong Kong? No one has those answers yet, but we definitely have some ways to think about it that we'll get back to you on.
Okay, thank you.
Yeah, of course. Does anyone else have any questions or anything they'd like to ask us, or maybe not necessarily in this point, but another question? If you have one, you can always raise your hand next to your name on the right-hand side, or you can just type out a quick question. Give it another couple minutes, and if not, then we'll just conclude. So, all right, I got a couple of private ones here. I think that's gonna be it then. Connor or Katie, is there anything else you guys would like to add in before we actually wrap this up?
All good on my end. I just want to thank everybody for the time. And Chris, thank you for including us. And again, hope everyone's staying healthy and safe. I appreciate it very much.
Yeah, it means the world to me that everyone took their time to actually just hop on this for a little bit today. As always, if you have other questions that arise after watching this, let me know. If there's anything that we briefly touched on, but you actually wanted us to deep dive into, let us know. We have a ton of resources available. More than happy to answer any questions. And the truth is, we're not going anywhere. So look forward to hearing from you whenever you're available. I'd like to thank BlackRock as well for doing this call today. It means a lot that you guys are our partners and that you're always available to me with the information that I need when I need it. So thank you guys very much. And that will conclude our seminar for today. So thank you all very much, and be on the lookout for our next invite in the next quarter. Thank you.